Welcome, everyone, and thank you again for your patience and understanding as we work through our technical issues with this particular webinar. I think we have them all sorted out, so we're going to dive in. Welcome, everyone, today to our immediate expensing webinar, where we're going to cover how to handle immediate expensing in tax cycles T1, T2, and T5013. My name is Sharka Hoida. I'm a CPA, CGA, and a tax analyst with TaxCycle. Before we get into the meat of the presentation, a few housekeeping things. We do recommend that you maximize your viewing windows so that you get the best view of all of the things that I'm going to show you here today. The webinar is being recorded. To rewatch it later, visit our webinar recordings page on the website. We do use polls to gauge your attendance and to help us gauge whether or not to award the verifiable professional development credits. So please make sure to answer all of the polls. This webinar will contain 4 of them. To receive your certificate for your PD credits, you must watch for at least the minimum amount of time and, as I mentioned, answer all of the polling questions. The certificate will be sent to you by email. Also, in the background, we have people available and ready to answer any questions you may have while we are running the live webinar. If you are watching this after it's been recorded and posted, then please feel free to send any questions you may have to info@taxcycle.com. So let's get into it. What is immediate expensing? Well, we all have had done our research, I'm sure, on this, but I'm just going to go over some of the basics of what is in Bill C-19, which is where all the rules are for immediate expensing. It's a temporary measure, so for a few years, that will allow a 100% CCA claim in the year for a designated immediate expensing property that becomes available for use in the year. It's subject to the immediate expensing limit, and it cannot be used to create or increase a loss for an individual or for a partnership. Who qualifies as an eligible person or partnership? So EPOP, there are lots of definitions related to this provision. Or this particular bill. So Canadian-controlled private corporations qualify, individuals other than a trust that are resident in Canada, or a Canadian partnership where all members are Canadian-controlled private corporations, individuals other than trusts resident in Canada throughout the year, or a combination of those two. Multi-tiered partnerships are specifically excluded from the immediate expensing provisions. What types of property are eligible? We have the properties that are acquired after April 18th, 2021, and that's only for the CCPCs. For individuals and Canadian partnerships, it's property acquired after December 31st, 2021, so starting in 22. And those are available for use in the case of partnerships where for CCPCs are partnerships where all of the partners are CCPCs, available for use before January 1, 2024. It's extended for individuals and partnerships where all the partners are individuals to January 1, 2025. So before that date, so effectively end of 2024. Applicable CCA classes. So there's a broad range of classes where immediate expensing applies. These are the ones where it does not apply. So all classes except for classes 1 to 6, 14.1, 17, 47, 49, and 51. The claim for immediate expensing is subject to the immediate expensing limit, the IEL, and is up to 1.5 million in a tax year. It's prorated for the short tax years, so less than 51 weeks. It's subject to allocation among eligible persons or partnerships, EPOPs. And I would recommend that you review ITR 1104, Section 3.6 for the interpretive rules for what is an associated eligible person or partnership. Um, so effectively, individuals and partnerships are deemed to be corporations for the purpose of the associated rules. The associated rules apply in the same or similar manner as for corporate associated entities. You can decide, you do have some latitude in terms of deciding which classes to allocate the immediate expensing to, where cost of capital exceeds your IEL limit allocated. So when deciding how to allocate your immediate expensing, you might want to give preference to your lower CCA rate classes, and maybe rate classes that don't benefit from other provisions like the accelerated investment incentive property provisions, so that you can maximize the claim if that is the goal in the tax year for your client. In the case of individuals, the applicable um, immediate expensing limit is allocated across all businesses and rental income statements. So that includes your T2125, your T2121, your farming T2042, including the Agri Stability and Agri Invest forms, and the rental statement. So there's also the definition of what is a designated immediate expensing property, a DIEP, and that is a qualifying immediate expensing property which is neither previously owned by the taxpayer or a non-arm's length person, and it has not been transferred to the taxpayer on a tax-deferred rollover basis. It has to qualify in the year it is available for use, and is designated in the prescribed form on or before 12 months after the filing due date. There are claim limitations. So we already mentioned the IEL, so that's the associated limit. It's also subject to undepreciated capital costs, so the UCC of the designated immediate expensing property, the EPOP, the immediate expensing limit allocated to that particular entity, where the eligible um, person or partnership is not a CCPC, then the income earned before the CCA deduction from the source of income that is business property or where the DIEP is used. So this is just a reminder that you cannot use the immediate expensing provision and claim CCA to create or increase a loss. And that's applicable to both individuals and to partnerships. So other things to think about when you're thinking about immediate expensing is that it is an optional provision. So there's no, you don't have to claim it. You can claim it where it's advantageous to your client or it makes sense. Keep in mind that a large deduction in the current year, so if you're writing off all of the, uh, if you're taking the maximum CCA in the current year, that's going to leave less to deduct in future years. So bear that in mind. So if you've got a client that has increasing income in future years, then maybe taking the full amount of immediate expensing may not make sense for that client. There's no carry forward on the immediate expensing limit, so timing of the acquisition for those assets is important. The tax rates for each member of the associated group should be considered in the allocation of the immediate expensing limit. So when you've identified your associated group, and you're doing your tax work, then it would make sense to allocate a larger limit where it's going to be most advantageous in that associated group. For individuals, the optimal claim should take into account personal tax credits as well when determining the amount of the CCA to claim, so that you're not losing that advantage and you still will keep some of that CCA to claim in a future year. Designated properties bought and sold in the same year where there's a trade-in do have some additional rules, and I encourage you to review what those are. And then we have some special considerations around motor vehicles, personal use of motor vehicles, particularly in the T1. And when we chatted about this internally yesterday, I think there's still a lot of gray area about how to manage the personal portion, how to prorate the immediate expensing between personal and business use and across multiple potential income streams in the T1, how to handle if the business use changes in a subsequent year. So if we're writing off 100% of the asset this year or claiming 100% of the CCA, and in a future year where that asset is still in use, there have a significant change in the personal versus business proportions. Is that going to be a concern down the road? How do we handle the year of disposition when recapture applies and there's a personal use portion that maybe is varied across the year? So I don't think there's a lot of guidance or information about how this is going to be applied or how CRA is going to interpret these rules. So I think those are just things to consider and think about when you're preparing your tax returns this year. So the rest of the presentation, we're going to chat about how to implement the immediate expensing inside of TaxCycle. So I'm going to cover in T2 and T5013 the S8 Asset Manager, the S8 Claim, and the S8 Forms, which are all the relevant forms where many of the settings are. In T2 only, there's also the Alberta schedule and the T2 CGI form, which is included, which is also used in the immediate expensing provisions as they're applied in our software. In T1, it'll be the asset manager, the CCA claim, the CCA, and the IEL worksheet. Each income statement, there's one IEL worksheet, but each income statement will have its own asset manager, claim, and CCA schedules associated with it. And of course, Revenue Quebec has their own specific forms. It's CO 130A in the T2 only, and in the T5013 and the T1, the 130AD and the TP 130EN also apply. So Quebec has split out and created a separate form for reporting the eligible limit, and they have created a separate form for reporting the designated CCA, the immediate expensing CCA items as well. All right, so I'm going to close this presentation, and then we are going to do 2 back-to-back polling questions. Tim?
Okay, so there'll be 4 polling questions in total today, and the first one is up on the screen right now. It reads, immediate expensing is available to which entities? Select all that apply. And the options are individuals with business or rental income, corporations, CCPCs, corporations other than CCPCs, partnerships, trusts, and registered charities. And we'll give everyone maybe a minute to answer that question, or 30 seconds. It looks like there's still a couple of answers coming in, so we'll give everyone maybe 10 more seconds. Okay, and on to the second polling question now. So the question, someone answered already, but the question reads, the immediate expensing limit, or IEL, is allocated among all eligible property and among associated corporations. The concept of associated corporations is expanded for the purpose of the IEL. True or false?
Okay, while everyone's getting that second polling question answer recorded, I am going to carry on. So in T1, that the rest of the bulk of the support is in the current release, which went out yesterday. It was also in a release that went out previous week, but some bug fixes were out. So the most current version is 49577. If you do not have that, then that is the release you want to make sure you are updated to. And you will see that here on the homepage of our tax cycle, which version you're on, and you can check here to see if you have the latest update. All right, so I created a sample file for demo purposes, and I already pre-populated a bunch of the information just to speed things up as I go through the various pieces that you're going to need to look at when you're in the file. And I'm going to start with the income statements. So down here, I'm just going to open this up to all forms for a second so you can see. So what's going to happen is when you create a new statement, so if I clicked on T2125, as you know, in TaxCycle, it's going to go ahead and open up all of the relevant forms that are related to that income statement. So in this case, I have two 2125s. One I have set up on the spouse and one I have set up on the principal. So we'll see both of those in here. So I have Rhodes Consulting, and then I also have Aqua Pursuits. So these are all the forms that get created underneath each of those. And that's the same for every single income form that you create in the software. So I'm just going to make that smaller so it's a little easier to read. And so in this case, the T776, so rental income, I have already added income information here. I'm just going to clear those. So as we're going down, you filled out everything in here. And so that should all be good. We now have income that we can use to allocate the CCA against. And again, remember that I cannot allocate income more than, or I cannot allocate immediate expensing CCA to any one of these income streams to create or increase a loss. So in this case, I have net income of 38,309. So the maximum immediate expensing claim I can make will be this, or the IEL limit that's allocated to this particular individual. So the next thing I wanted to show you was the claim form, the CCA claim. So we're going to go to our side menu here, CCA claim, or fast find F4 to find the form that you're looking for. And the important things here are some of the main settings that drive the immediate expensing. So as you scroll down the form, you'll see here the immediate expensing incentive additional settings that have been added. So the first one is the individual eligible for the immediate expensing incentive? So this is calculated for you. So we will determine if they're a Canadian resident eligible for the immediate expensing incentive. And in this case, yes. So that is selected for me. And it will automatically apply the immediate expensing calculations to the income statement. If I don't want to claim any immediate expensing, then I can just turn this to no, or set this to no, and none of those calculations will be used in the calculation of the tax owing for this taxpayer. But a caveat, it's just applicable to this particular statement. The way that it's going to work in T1 is that each one of these CCA claims for each statement has its own set of immediate expensing incentive optimizations and claim options. So I can turn it off just for this property claim if I'd like, but leave it on for the other ones. Or if I don't want to claim immediate expensing for anyone, then you'll need to go into each one of these CCA claim forms that are applicable and set this to no. So I'm just going to remove this override because I want to show you what happens when it is calculated. And by default, we have the manually allocate the immediate expensing limit set to no. If you want to manually allocate your limit for the DIEP or for the income earned from the business or property in which that DIEP is used, then you can set those defaults here. And again, that is just for this one income statement. You would need to do that for every income statement that is applicable. So next we will move on to the asset form. So on the asset, I've already created a few here. There's a little reminder in the top that we have a help topic here on T1 immediate expensing. And I would encourage you to also review that in conjunction with this webinar. There's some additional examples and information there for you. Now, I already covered in the rules that class 1 does not apply for immediate expensing, but I put that in here just so that we have some items populated on our claim so you can see how all of the calculations work. I've added some landscaping equipment already here, some additions, and I've also added some lobby furniture. But let's go ahead and create a new one. Let's assume they bought a computer system, and we're going to make that a class 50. And if you want to see the additional calculations for the CCA, accelerated CCA in here as well, so you can see the comparison, you just check this box here. And then when you scroll down, all of those additional AIIP calculations are going to show for you. But because we're focused here today on the immediate expensing, I'm going to leave that off. And now if I scroll down, we're going to add the asset down here. And let's say it was a really expensive computer system. So I'm going to put in the cost of the addition. I verified that it meets all of my rules to be designated immediate expensing property. Sorry. And so it's automatically selected yes because I'm in the 2022 module. And we're going to assume, if there's no date, that it was added at the beginning of the year. But you will need to add the year as well for tracking. So I'm going to just say maybe they bought it in February around the 10th. And so we've automatically calculated that this class is eligible for the DIEP and the AIIP as well. And so all of those rules are going to be applied above. So if I scroll back up here to my calculation, you'll see that the DIEP has been added here. And then if there are any adjustments, you would enter that into this field on row C. We get our final UCC for the opening balance of this particular property. And the calculations run down here in G and H are the calculated limits. So because we left the calculations on from TaxCycle, it is telling us that we have available income of 122,000 and change, and the IEL limit is set to 15,000, and we'll review the IEL statement in a minute. So it's the lesser of those two that we can claim. So it's claiming the 15,000. That will roll up into our CCA claim section up top. And then if we go to our CCA schedule, you will see it is added here in the row. So there's our 15,000. You will see the extra rows that we added here, which are the net income before. So these are our limiting columns. The net income and the immediate expensing, sorry, 8.1 and 8.2 are the immediate expensing limit and the deductions. So if you're trying to figure out which asset you want to preferentially allocate to, and we chatted about probably you'd want to start with your lower CCA rated classes to maximize your claim, then this is a really good view because you can see in a snapshot exactly row by row, asset by asset, or class by class, how that is getting allocated for this particular statement. Now, I also just want to go back to the asset form for a second, and we're going to go back down to my computer that I added. The other item that is important here is the disposition. So if you're disposing of the DIEP, then you'll also need to check the box here to say, yes, I'm disposing of that, because there are special rules on disposition that require recapture in most cases. If it's happening within the year, so it's purchased and disposed of in the same year, you would select yes, and we would put in the proceeds of disposition along with the cost of the asset here on the same row. So I'm going to leave that as no. So then we have all of our income statements in. The other thing that we chatted about was the immediate expensing limit. So all of this is subject to those limits. This is the form that is where you're going to list all of your associated entities. And remember, an individual is a deemed corporation for the purpose of the immediate expensing provisions, as is a partnership. And there's some special rules around that, which I would encourage you to review. And in this case, in my scenario, we have, so these are all of the T1 related income streams. But I'm also going to show you a T2. So we also have Chucks, sporting goods. So I have to add them into this schedule as part of the associated group. And I'm allocating them a larger limit. And then I also have a partnership that I've identified that is associated. And I'm going to give them part of this limit as well. Actually, leave that. Okay, so now I've identified all of my associated groups. I have my net income. I have my allocation of the immediate expensing limit here, and I'm getting pretty close to my maximum. If I want to claim some other amount that is less than the allocation here, I have that option to select yes over here to claim a different percentage or dollar amount for this particular income stream. But for the purposes of today, I'm just going to leave that as no. So now I have a snapshot of how that immediate expensing limit applies. And TaxCycle is going to go ahead and make sure that we are within our limits of the 1.5 million that's available to me in the tax year. And then, of course, this is all shared with the spouse as well. I'm going to pause here to do another polling question, and then I'm going to come back and we're going to chat specifically about motor vehicles in T1. So, Tim?
Okay, that's my cue. So this is the third question out of the four that we're doing today, and it's up on the screen now. It reads, in TaxCycle, the immediate expensing incentive options appear on which forms? And there's a couple of options here. The first one is asset manager, such as S8 asset in T2, or the T2125 asset in T1. CCA claim worksheet, such as S8 claim in T2, or the T2125 CCA claim in T1. CCA worksheet, such as S8 in T2 or T2125 CCA in T1, CGI in T2 or IEL in T1 worksheets, or all of the above.
Thank you, Tim. All right, so a special consideration in T1, well, two special considerations that I'm going to point out for you. One is on the T2125, where if you have a partnership that you're claiming additional expenses for on a T2125, this section, part 6, I believe it is, I'm getting there. I don't want to scroll too fast or it looks funny on your screen. Yeah, so part 6, this section here for the CCA for partners only, this does not have the calculations for immediate expensing currently in place. For this section, we have made this a lower priority because the other items were going to be higher use. If you do, for whatever reason, want to make a claim for immediate expensing here, you would just override the CCA amounts that are calculated and claim them in here. Keep this with your backup in case CRA asks for backup for that calculation. So that is one. The other exception is on your motor vehicle worksheet. So if you're using the motor vehicle worksheet and you have one or multiple income streams, then the CCA information is at the bottom of this form for that vehicle. And you would fill it out as per usual. If you were claiming immediate expensing, then you would just select here to claim a different amount. and claim the amount of the immediate expensing that you are claiming in the year for this particular asset. And then that will all roll up into the appropriate calculations. I believe that we're not adding support for the motor vehicle worksheet in this year, but we are reviewing it to add into the 2023 T1 module. It's a bit more complicated just because of all of the sharing amongst income streams and sharing with spouse. So we just thought it was safer to focus on the ones that we knew that we could get in. And this one will require considerable more work to get implemented. So for now, you would just go ahead and claim the different amount. So that is T1 and immediate expensing. And so I'm just going to go ahead now and close this file. And we'll move on to T2. So T2 is going to be similar. And you may already be familiar with T2 because it's been available in the T2 module for some time. It works in much the same way. So we have our asset schedule where I started to claim. So I'm assuming that they bought a limousine. We're going to class it as a motor vehicle and not a passenger vehicle. And we're going to go, the checkbox to show the additional calculation is here. So same as in T1. And we're going to go down here. We're going to add our limo. And they're expensive, so I'm just going to say it's expensive. In T2, it's going to assume that the item is added at the start of the fiscal year. So DIEP, that box is going to calculate based on that assumption. You will have to put in the actual date. And then we'll just double check that that's within the range that's available for the DIEP. So this works exactly the same way as what I just demoed in the T1. We have our disposition DIEP selection here as well. If I go up, we go to our immediate expensing section. So it's the same, but this one is not income limited. It's only limited to the lesser of the UCC or the immediate expensing limit. So those amounts are here. And because I have Alberta and Quebec selected as well, I also get the additional Alberta and Quebec columns as well. So you'll just want to make sure that the claims are what you want them to be for each of those applicable provinces as well. And then, like in T1, in T2 on the claim, there is a section added here for immediate expensing, and that is calculated for you. So same idea, whether or not the corporation is eligible for immediate expensing will calculate for you. And as I mentioned early on in the presentation, it's only available to CCPCs, and CCPCs are designated on the info form here in the type of corporation at year end. So because I'm a CCPC in this example, then that is calculated to yes. And automatically it's saying, yes, I'm going to apply immediate expensing calculations to this return. If I do not want to use or claim immediate expensing, I can just override that and select no. But in this case, I'm going to leave that. And then you can also say that, yes, you want to manually allocate the limit by asset. You might not like the way that TaxCycle has optimized those calculations for you. You do have the option to manually enter them. And you can do that either on the specific asset, or if you go to the S8, there are the columns here, 11.1 and 12, where those amounts show on a class by class for each line. So you can go down and quickly update those amounts here to be what you want them if you wanted to manually allocate. And then, of course, we also have the optimized amount, which you can change down here. You can claim a different amount if you like. That has not changed. I also mentioned that if you're filing in Alberta, all of those amounts will flow to your AS13. If you're filing in Quebec, they will flow to your QC 8AD in TaxCycle, which is the CO 130AD. And this is all of the specific property additions where you're claiming immediate expensing. And then the QC8EN, which is the immediate expensing, so all of your associated groups. So everything federally will flow to the applicable forms here. To enter your associated group for the purpose of the immediate expensing limit, you do that on your CGI form. We have added additional supports here for that. So in this case, I have to add Chuck because he is a designated associated or deemed associated corporation for the purposes of this provision. And so we would add his info. And I'm going to select here that he's a deemed corporation. The tax year is the calendar year. Oh, I put this in, sorry, I put this in the wrong box. This has to go over here. And then I also need to include that partnership, which is part of my group. And I cannot remember what I used for their tax year, but I'm going to assume it was also the calendar year. Again, check the box, and then I have to put in their tax ID number. So now I've got all my associated group in there. If I go to my S8 asset at the top of this form, there is a new section where all of that information is going to flow. So all of the associated group entities, and it's going to automatically select yes for me when I add any additional rows to this table. So I can add them here, but I prefer to add them on the CGI form. It's cleaner, and then it's also here for any with everything else for me to view if I need to have a look at that later. So that is for T2, and I'm going to pause one more time for our last polling question.
Sounds good. So our last polling question of the day is up right now. Is a true or false one, and it reads: partnerships can only claim immediate expensing to the extent that they have applicable business income. Partnerships cannot create a loss using the immediate expensing incentive. True or false?
Now that, so I'm going to jump back in here. Where's that limit coming from? So we also have to, on our S8, also allocate the percentage of the claim. I think we wanted to do a 40. 20 split-ish. So don't forget to also fill that portion out on your S8 schedule. So I'm going to go ahead and close my T2 now. I'm not going to save this one. And we'll move on to T5013. So T5013 is, again, much the same as what I have already covered. The difference between T2 and T5013 is that it follows the rule in T1, which is that you cannot claim the immediate expensing provision to create or increase a loss. And it is subject to the income test as well. So you do have to allocate the income to the asset as well where you're claiming it. So again, we're on the S8, and I've already added one here just to speed things up because we've already reviewed this a couple of times. You'll have the same, you have the same box at the top to show or hide the AIIP calculations. And we're going to go to the immediate expensing section. So I've already added one here. And in this case, I have manually added the income and the IEL. So in partnerships, it was a little bit harder to determine how to allocate that income in particular because there are numerous business types of income that are available, so a multitude of lines that are applicable. So I think in the end, we decided that it would be easier if that is manually allocated. I think there was an attempt to calculate that, and I'm not sure at this point how far along that is. But on the S8 claim, we have all of the same questions that you saw in T1 basically. So whether or not the partnership is eligible for the immediate expensing claim, whether or not it's getting applied to this particular tax return, whether or not you want to manually allocate the IEL, the immediate expensing limit, or the income earned to that particular property. Those settings are all here on the S8 claim. Two things that are important for T5013 is that on the info form, and again along the side, fast find, or I had them already open here, we've added two questions here that are specific to immediate expensing. And members calculates for us so we know if everyone's a CCP, a corporation. But what we don't know is if all of those corporations are CCPCs. So you'll need to answer this question here, whether or not all of the corporate partners are CCPCs, or the partners are made up of individuals and CCPCs. And then if the members are all for all of the individual partners, if they're all individuals and no trusts throughout the fiscal year. So these two questions will trigger whether or not immediate expensing is applicable for the T5013. And then we go to the S8. So S8 is essentially the same as what you have in the T2 module. We don't have a CGI worksheet or any other place to put the associated group. So you would just go ahead and enter that here. I'm going to skip entering that, and you would assign the amount. So you would go ahead and enter all of your associated group here the same way that we did on the T2 and for the T1. And if we scroll down, this part of the schedule is essentially the same as in T2 with the exception of we have the added column for the income earned associated with the designated immediate expensing property. So this column is here. You can go ahead and review this on your S8 and make adjustments in these columns if you would like to see what different allocations will do for how that income gets reported to find the most efficient options for your client. And then if Quebec applies, we also support the CO 130AD and the TP 138EN, which I already showed you in the other in T2. So you'll see that all of the information that I entered federally will flow down to the relevant provincial schedules as well. So that is all that I had to show you as it relates to immediate expensing and how it is applied in TaxCycle. Thank you again for joining me here today. I hope that this was helpful, and good luck with the rest of your tax season. Bye for now.